In last few days, there has been quite a bit of chatter if US will go into recession. And even Federal Reserve just admitted that recession is coming. First, it was because of Russia and oil crisis, and then it became a bigger issue of interest rate and rate hikes. And now it looks like big banks are agreeing to it. During the Q1 earnings call, JP Morgan CEO Jamie Dimon did mention that the ongoing war in Ukraine, high inflation, and the Federal Reserve's hawkish stance on the monetary policies could combine to significantly increase the chances of a recession. Last week, Bank of America's chief investment strategist Michael Harnett also mentioned that the recession shock is coming. This warning came ahead of the new CPI report released on Tuesday that showed consumer price index surged by 8.5% in March, the fastest pace since December 1981. Several economists believe that there are 1 in 3 chances that US economy will enter into recession by the end of this year. But does that mean you should stop investing and wait for US to crawl its way out of recession? Well, not really. I did some research on my side and the results are shocking. Hey everyone, it's Mr. Mo here, aka your frugal investor, and welcome to my channel. During the difficult time of recession, many people suffer economically and even more worry that they might too. But not all businesses and industries feel the same pain during the economic downturn. Some businesses even benefit as consumers cut back on substitute products and other competing options. Many of the businesses that do well during recession either provide goods and services that increase in demand directly due to recession conditions by offering cheaper alternatives to luxuries or big ticket purchases, or for which the demand is relatively inflexible to changes in incomes. Example of those businesses are like accountants, healthcare providers, financial advisors, auto repair, home maintenance stores, property management companies, grocery stores, and discount stores. And that brings up opportunity for us as an investor to invest in these companies which thrive during recession. That being said, here are 5 ETFs that you can look to invest in during recession. Number 1, XLP, the Consumer Staple Select Sector SPDR ETF. XLP outperformed compared to other ETFs during the housing market crash between 2008 and 2009. To date, it remains the most liquid and actively traded consumer staple exchange traded fund. They have $15.3 billion assets under management with 0.13% expense ratio, and they pay out a yearly dividend yield of 2.49%. Their top 3 holdings are in Procter & Gamble, Coca-Cola, and Pepsi. At number 2, we have XLU, the Utilities Select Sector SPDR ETF. When the market is rough and economy is shaky, investors often dive into safe haven sector where the dividends are high and the products and services are in demand. That's why utility stocks are one of the Wall Street favorites during these rough times. XLU is the collection of roughly 30 companies that deliver electricity, gas, water, and other utility services that you and I more or less can't live without, no matter what the economy is doing. They have $14.9 billion assets under management with an expense ratio of 0.10%, and they pay out a yearly dividend of 2.88%. The top 3 holdings are in Next Era Energy, Duke Energy, and Southern Co. At number 3, we have USMV, iShare Edge MSCI Minimum Volatility USA ETF. Low volatility funds are designed to keep investors exposed to stock market upside while reducing risk. Because of this, they may outperform during the bull market, but they are built in such a way that they should outperform when the bear takes control, especially during recession. The strategy is simple. Hold the stocks with lower volatility characteristics relative to the broader US equity market. USMV is one of the largest fund at well more than $28 billion assets under management with a 0.15% expense ratio, and they pay out an annual yield of 1.5%. The top 3 holdings are in Eli Lilly, Microsoft, Accenture, and T-Mobile. Next at number 4, we have IHF, iShare US Healthcare Providers ETF. This ETF measures the performance of healthcare providers of the US equity market. Healthcare sector generally outperforms during the period of low growth and high uncertainty. During times of recession, we will see a huge investor interest due to its non-cyclical nature. Also, it's observed that demand for healthcare services remain intact even in the deteriorating economic fundamentals. IHF has total $1.3 billion assets under management with an annual yield of 0.51%. Their top 3 holdings are in United Health Group, CVS, and Anthem Incorporated. And the last one at number 5, we have VDC, Vanguard Consumer Staple ETF. The consumer staple sector is viewed as defensive as it includes a variety of items like foods and beverages, non-durable household goods, hypermarkets, and consumer supercenters that are essential for our daily needs. These everyday household products see a steady demand even during an economic downturn, including recession. VDC has in total $7.93 billion assets under management, and they pay out an annual dividend yield of 2.43%. The top holdings are in Procter & Gamble, Coca-Cola, Walmart, Pepsi, and Costco. And there you go, guys. These were the 5 ETFs that you can consider to investing during the times of recession. And for any reason, if I did provide you any value today, please drop a like on this video and subscribe to my channel, and see you in the next one.